Have you ever wondered when and where investing began? Surely it didn't start with the dawn of the dinosaurs, nor with the rise of our ancestors. History recorded that it has first publicly been practiced upon the Republic of the northwestern part of Europe. Hit the like and subscribe button and watch as I unravel how a trading company came to become the first ever corporate model of a vertically integrated supply chain, which greatly influenced today's method of investing in stocks. Trading and exploring were everything back in the early 1500s. Spearheaded by Portugal, Spain, and the Dutch Republic, no island was to be left unturned. But due to the union of the Portuguese and Spanish crowns, the Dutch Republic ultimately had a bigger rival to face. For the sake of protecting the ships from enemies, the Dutch East India Company was created, which involved several countries forming an alliance. In the 1600s, even with frequent attacks and ambushes, the Dutch East India Company developed numerous ships to trade gold, porcelain, spices, and silk all around the globe, but this didn't come cheap. At that time, it was customary for a company to be funded only for the duration of a single voyage, and to be liquidated upon the return of the ship. Moreover, there were also associated risks on these journeys, such as shipwreck and disease. To manage such risks and to fund these expensive expeditions, a cartel was formed following the suit of their English neighbors. The company relied on their private citizens for funds so that their trip could begin. In exchange, the citizens would have a share of the ship's profit once it returns. The Dutch East India Company expanded their shareholders to not only those of affluent individuals, but also to those of booming businesses across the region. This method enabled the company to go into grander voyages, resulting in even greater profit for both their investors and themselves. The company was a transcontinental employer and a corporate pioneer of outward foreign direct investment in the early modern world. It unknowingly became the world's first ever stock market. As time passed by, the stock market wasn't singularly focused on ship voyages and expeditions anymore. It involved careers, schools, and all forms of businesses. Without the use of spices and gold and silk, how does the modern world integrate stocks into the market? If you like what you've seen so far, make sure that you hit the like and subscribe button on our channel. Let's begin with a simple analogy to a new fast food company. Before going all out on the new business, the company would first look for investors to fund their cause. Beginning shares, profits, and a future outlook would be presented for the sole purpose of convincing them to partake in the growth of the newly built company. And if they took a liking to it, the investors would be the first ones to impart funds, officially launching the company into the market. As the company continues to thrive, more and more investors would buy stocks. The acquisition of stocks on the market would signify that the investor owns a fraction of the company. Following a directly proportional relationship, as demand for the stock increases, so does its price. Moreover, stocks of individuals who purchased earlier would also increase in value. Thus, it's always better to invest in a company that holds great potential in a term described as growth investing, which I've discussed in another video, although it comes with its own risks. A rise in the company's interest gives a new opportunity for it to grow and develop. An upgraded menu, a renovation on the building, or something as simple as a new cup design can be a huge factor in attracting customers and increasing sales. However, in turbulent times when the company doesn't prosper and is on the path of decline, investors can sell their stocks with the hopes of making a profit before acquiring loss. Some companies recover, but others don't, leading to stock prices falling and with it, the market value of the company. It's important to note that this ever-changing stance on the market is caused not by a single component, but by many different factors, ranging from the rise and fall of the costs of labor, production expenses, and a more recent example, declaration of war among two countries, which greatly affected the price of oil across the globe, resulting to an increase in not only transportation fees, but also daily consumption of products that we use in our everyday lives. How has the war affected your country? Changes can definitely be observed all around us, and that is on top of the ongoing pandemic. Comment down below how you're coping with the current global situation, and by the way, don't forget to subscribe to this channel. Politics can also come into play as a factor in an investor's worry. There's also public interest. And sometimes investors just want to let go of the reins to pursue personal interests, which causes them to sell valuable stocks. The stock market is infamous for its seesaw of changes by the minute. A company is not abruptly sentenced to bankruptcy as the market makes these numerous corporations seem successful for a day and on decline the other. However, those that appear to be losing value tend to lose investors if they cannot recover quickly, thus leading to an actual loss in value. Investors are a bunch of easily influenced individuals. That's why it's essential that companies uphold their values to boost the morale of their employees for more efficient work performance and to dissipate the worries of their investors. With confidence alone, humans can overturn the market. From economic booms to financial crises, it's been done several times and will continue to happen in years to come. And this unpredictable pattern is the reason why investing in quick cash comes with many risks in comparison to long term investing. Although it does not yield money right away, you can rest assured that there's guaranteed profit in the long run. After all, it takes time for flowers to bloom. However, recent research has been conducted and tools are constantly being made by experts in an effort to increase the success rate of this unpredictable system. Contrary to popular knowledge, the stock market is not only exclusive to the rich and powerful. In fact, investors can be just anyone. We've achieved milestones of discoveries leading to more sustainable and more comfortable lives compared to before. With the development of technology, our chances of bettering our lives developed as well. Through open access to the internet, everyone is rendered equal in this field, as people can purchase stocks the same way an expert, large, and affluent investor would. As more and more people open their minds to the idea of investing, they can also support upcoming businesses by buying, selling, and trading stocks. Soon, cash will flow in passively, and there will be less need to actively be on the side of work as you become an investor yourself to achieve your financial goals and expand it into more profiting businesses. Investing requires time and effort to master, but once you come to understand the pattern, it will have a domino effect. Just like how a simple trading company influenced the world that we live in today. I hope that you gained a lot from today's video. Continue to learn until you reach your goal. Before you go, don't forget to hit the like and subscribe button. See you!